Markets are soaring, but what if they're climbing for the wrong reasons? This is Weekly Market Update, a cutting-edge podcast where two generative AIs, guided by a former senior portfolio manager, cut through the noise to deliver what really matters. In under 15 minutes, we'll expose the 5 hidden risks that could shake global markets this summer. Before you make your next move, ask yourself, are you trading the rally or ignoring the cracks? Don't miss this one. Hit play and stay ahead.
Markets. This week, we're cutting through the headlines to uncover what truly fueled the recent surge in global equities, and maybe more importantly, what hidden currents could shift fortunes in the days ahead.
Exactly.
Think of us as your guides, helping you navigate these complex economic signals, region by region, and really arming you with the crucial insights every investor needs to watch. Let's unpack the real story behind the numbers.
That's right. And while the market has certainly been, buoyant, the underlying data paints a much more nuanced picture. Our mission today is to show you precisely where the market's focus currently lies and where those often overlooked vulnerabilities are lurking. It's about understanding the why behind the what, really.
Okay, let's start with the economic powerhouse itself, the U.S. markets. We've just seen U.S. stocks surge. The S&P 500 up 3.44%, Nasdaq jumping 4.25%, the Dow gaining 3.00%, all of them hitting fresh all-time highs. It's quite a remarkable run, but what powered it? Was it pure economic strength or maybe something else entirely?
Well, what's fascinating here is how much of this uplift came from, pure sentiment. You had hopes of a breakthrough U.S.-China trade deal, the prospect of some additional trade agreements, and critically, very dovish comments from Federal Reserve officials hinting strongly at potential rate cuts.
Okay.
It was a potent cocktail for market optimism,
But here's where it gets truly intriguing, maybe a little paradoxical. Despite this market euphoria, the economic data offers some surprisingly mixed signals. We saw core PCE inflation, that's the Fed's preferred gauge rise, 0.2% month over month and 2.7% year over year in May. That's slightly ahead of expectations, and it's actually ticking higher, not lower. And then personal income and spending declined unexpectedly. So what's the real takeaway here? Is the market maybe missing something crucial by focusing just on optimism?
Absolutely. While optimism is clearly driving sentiment, those subtle shifts in core PCE and consumer spending suggest we might be seeing a disconnect. It's a bit like a car with a shiny new paint job, but maybe a subtle engine rattle.
Yeah.
The market sees the paint, right? But the underlying data points to potential issues. The surprising part is how resilient equities have been despite these cracks, perhaps betting too heavily on future Fed action. For instance, consumer inflation expectations, measured by a key survey, did fall sharply, signaling less concern over tariffs. But the actual core inflation figure, that suggests persistence.
Okay.
Now, on the flip side, we did see durable goods orders soar by 16.4% in May, highest pace in 11 years, largely thanks to aircraft bookings.
Big number.
Huge. And core business investment, excluding defense and aircraft, also rose a healthy 1.7%. So there's a pocket of business strength there. However, the services PMI decelerated slightly, and the overall composite PMI tracking both manufacturing and services came in at 52.8. That only indicates modest expansion. As one chief business economist put it, while the economy is still growing, the outlook is uncertain, and inflationary pressures have actually, risen.
And the housing market, always a key indicator of consumer health, continues to show weakness. New home sales slumped to their lowest level since October of last year. Existing home sales, they ticked up slightly, but remained historically weak, slowest pace for a May reading since 2009.
Exactly.
It's not just the stock market feeling the squeeze. Even that dream of homeownership feels more distant for many.
Precisely. It's a bit like trying to drive with one foot on the gas and one on the brake. You're moving, sure, but not smoothly.
Yeah.
It highlights that underlying consumer resilience isn't maybe as robust as the equity market suggests.
Right. So this raises a critical question for investors, doesn't it?
It really does. Can equities truly maintain this rally if consumer strength shows cracks and inflation remains stubbornly high? The bond market is certainly paying attention. Treasuries saw positive returns. Yields generally decreased. In fact, the probability of a Fed rate cut in July, it rose from about 14.5% the prior week to around 19% by Friday afternoon, according to the CME FedWatch tool. That shift was driven by that softer economic data and those dovish Fed remarks we mentioned.
So we've seen the U.S. market trying to balance this optimism with some pretty stubborn data. let's cast our gaze across the Atlantic. If the U.S. market is navigating a paradox, what story are Europe's charts telling us about their own economic tightrope walk? European equities also rose, S2XX 600 up 1.32%. Feels like a relief rally.
It does.
But does that actually solve anything, or is it just kicking the can down the road given the underlying stagnation? What's your take on its sustainability?
That's precisely the critical question, isn't it? While European markets certainly benefited from easing geopolitical fears like that ceasefire between Israel and Iran and prospects of fiscal stimulus, particularly maybe in Germany, the economic fundamentals show worrying signs of stagnation. The Eurozone's composite PMI was nearly flat at 50.2, unchanged from May. Services activity expanded only slightly after a contraction. Germany saw a slight rebound, but France remained in contraction for a 10th straight month, and its slump actually deepened.
10th month, wow.
So it really feels more about relief from potential bad news rather than genuine excitement about good news. That paints a very different picture for investors, doesn't it?
It absolutely does. Yet inflation showed some stubbornness over there, too. Preliminary June data revealed hotter than expected inflation in France, up 0.8% year over year. Spain's headline rate also rose to 2.2%, mostly driven by higher services costs and a rebound in fuel prices.
And this persistent inflation is noteworthy, especially when you see euro area business and consumer sentiment actually declined in June. The economic sentiment index fell to 94 from 94.8. That was driven by lower confidence across industry, retail, and consumers.
So a broader lack of confidence despite the market gains.
Exactly. And in the UK, Bank of England Governor Bailey emphasized economic slack. He noted the labor market was softening. He indicated any rate cuts would be very gradual, very deliberate. Domestic factors are more important for UK monetary policy, he stressed.
Okay. So, pulling this all together for Europe, what's the key takeaway for our listeners?
Well, Europe is indeed experiencing a kind of relief rally, yes. But weak demand and that persistent inflation continue to cloud the growth and policy outlook. It's a really delicate balance for the central bankers there.
Particularly with sentiment weakening despite the market's climb.
Indeed. It's a tightrope walk for the European Central Bank, no question.
Now, let's hop over to Asia. Japan's Nikkei 225 posted strong gains, 4.55%. The broader 2px index up 2.50%. What's fueling this significant rebound in a region often seen as quite sensitive to global trade winds?
Japan's market rebound was definitely fueled by improving global sentiment and a strong tech-led rally, plus those easing concerns about global trade wars and the Middle East ceasefire holding. However, the Bank of Japan, the BOJ, faces a really tricky balancing act. Tokyo's core CPI came in at 3.1% year over year in June. Still above the BOJ's 2% target, though slightly below forecasts.
Still high.
Still high. And despite some hawkish voices within the BOJ, some even opposed plans to slow bond purchase tapering, the central bank is keeping rates steady. They're citing global uncertainties, particularly around U.S. tariffs.
It makes sense.
This cautious stance has seen the yen strengthen a bit to 144 per U.S. dollar from about 146 the prior week. It's like walking that tightrope between supporting growth and reining in inflation, and with internal dissent, well, it makes that walk even more precarious.
Over to China now, where equities also rose. Shanghai Composite up 1.91%, CSI 300 gaining 1.95%, and Hong Kong's Hang Seng rallied 3.20%. This came after news of a U.S.-China trade framework. But isn't there a risk that the market is getting a bit too optimistic on these trade deals, especially given how quickly sentiments can reverse?
That's a very valid concern. The trade accord, which Beijing confirmed, included rare earth commitments, certainly lifted spirits. It temporarily stabilized trade relations.
Temporarily being the key word, maybe?
Could be. Details remain sparse, and contentious issues like fentanyl trafficking, digital trade, they're still unresolved. Any perceived backtracking could quickly unwind this optimism. The People's Bank of China, the PBOC, they acknowledged rising confidence and some positive economic signs, but they also flagged persistent weak domestic demand and deflation risks as weighing on activity.
Weak demand again.
Exactly. They pledged a moderately loose monetary policy stance, taking domestic and international conditions into account, aiming for stable economic growth and prices within a reasonable range.
So if we pull all this together for China's recovery, what's the bottom line? Is this trade boost enough, or does it need something more fundamental?
While the trade progress provided a nice sentiment boost, China's fragile recovery still requires stronger, more direct policy support, especially given that persistent weak domestic demand. The central bank's flexible approach will be crucial, but, it's a marathon, not a sprint.
All right. As we look ahead then, what key data releases and events should our listeners be watching closely from June 30th to July 4th? These are the moments that could really swing market sentiment next week.
Okay, in the United States, Tuesday, July 1st brings JOLTS's job openings, that's job vacancies, and the ISM manufacturing PMI, key manufacturing read.
Got it.
Wednesday, July 2nd features the ADP jobs report, construction spending, and factory orders.
Yeah.
Then Thursday, July 3rd is a particularly big day. We get non-farm payrolls, the big monthly employment report, weekly jobless claims, the ISM non-manufacturing index for services, and the trade balance.
Easy Thursday.
Very. And do note, U.S. markets close early on Thursday and are entirely closed on Friday, July 4th for U.S. Independence Day.
Good reminder. And for Europe, what should we watch there?
Monday, June 30th, we'll see preliminary June inflation data from Italy and Germany. Then Eurozone flash inflation follows on Tuesday, July 1st. We'll also get ongoing updates on French and Spanish inflation data, plus Euro area confidence gauges throughout the week, all critical for gating the ECB's next moves.
Okay. And for Japan and China, any crucial releases coming up?
For Japan, there's the Tankan Q2 business survey on Tuesday, July 1st. That's a big quarterly report on business sentiment, and the Consumer Confidence Index on Wednesday, July 2nd. For China, Monday, June 30th brings the NBS manufacturing PMI for June, and Tuesday, July 1st, the Caixin manufacturing PMI. These data points are really critical for understanding the ongoing market trends and how central banks might respond.
Perfect. Now, beyond the immediate headlines and the scheduled data, let's talk risks. What are the top 5 risks investors should really be paying attention to right now? These aren't just isolated events, right? They feel interconnected, shaping the whole global financial landscape.
Absolutely. Let's cut through the noise and look at the undercurrents, what's truly brewing beneath the surface. I'd list them like this.
Okay, hit us with number 1.
1. Global policy divergence risk. While some central banks are hinting at rate cuts, you've got persistent inflation in key regions like the U.S. and the Eurozone. This is creating a widening policy gap that could lead to significant currency volatility, unpredictable capital flows, impacting global investment strategies very differently than if everyone was moving together.
Right. Divergence is key. Number 2.
2. Escalating tariff shock spillovers. We're seeing more than just talk now. Global business activity is weakening, and the rise in overall costs hitting near 2023 highs. It's widely being blamed on tariffs. This isn't just about specific goods. It could severely disrupt global supply chains and squeeze profitability for companies worldwide wherever they operate.
A ripple effect, basically. Okay, 3.
3. China's consumer demand conundrum. Despite some trade breakthroughs, China's core problem remains that insufficient domestic demand. This isn't a minor hurdle. It's a fundamental challenge to their economic recovery. Even their central bank acknowledges it. Without stronger internal consumption, that rebound stays fragile.
Got it. Number 4.
4. Eurozone's inflationary trap. That hotter-than-expected preliminary June inflation data in France and Spain. Driven by services and fuel, it puts the European Central Bank in a really tough spot. It could delay their rate cut path even as economic growth remains stagnant. That might just prolong the economic malaise there.
Stuck between a rock and a hard place. And number 5.
5. BOJ's internal monetary policy strife. There are clearly divergent opinions within the Bank of Japan, especially on tapering bond purchases. One hawkish board member even opposed the plan to slow the pace of Japanese government bond tapering.
Interesting.
Yeah, it signals rising internal tension, creates real uncertainty about their future monetary policy direction and the normalization of long-term rates. It just means their path forward could be bumpier than maybe people expect.
So there you have it. Equity markets are certainly riding a wave of optimism, but as we've discussed, the landscape is still, well, dotted with critical economic data points and policy challenges. That delicate balance between growth hopes and persistent inflation will continue to define the market narrative, it seems.
Absolutely. And the week ahead, with its crucial labor, inflation, and manufacturing data across the globe, holds the potential to significantly reshape those rate cut expectations and impact market direction. It's really going to test the current sentiment.
Which brings us to an important question for you, our listener, to consider. As markets continue to rally, hitting new highs, how much of this reflects genuine, sustainable economic strength? And how much is simply a discounting of future central bank policy actions that may or may not fully materialize? Keep digging into those numbers, keep asking those deeper questions. We'll be back next week for another...
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.